Welcome to the Ellsworth Advisors monthly update for June 2024. I'm Kelly Keenan. This is Patrick Justice. Today we will review latest economic numbers, discuss how our portfolios performed for the month and year to date, then also discuss what our expectations are moving forward. So, Patrick, why don't you kick us off with some economic numbers?
Sure. Thanks, Kelly. Hope everybody's having a great summer. Let's dive right in. So I wanted to start with growth numbers. According to the Atlanta Fed GDP Now, published on July 1st, the seasonally adjusted annual real GDP figure sits at 1.7% right now. This number's down from some of those high threes, low fours that we thought might come in midway through the second quarter. But it's more in line with some of those numbers you and Cam have talked about the last couple months for the first quarter. So pretty steady as far as growth goes for the first two quarters thus far.
It will definitely slow down. I mean, that was the Fed's objective, keeping rates high, was to slow down the economy, and to stave off inflation. So, yeah, things are slowing down, and the 4% estimates earlier in the year, I think,
A little healthy.
may not be happening.
Right. From a labor force or job numbers, according to the Bureau of Labor Statistics, non-farm payroll employment increased by 272,000 in May. Higher than the monthly average gain of 232,000 per month over the last 12 months. So that's a good sign. Unemployment rate remains steady at 4%. So labor markets are continuing to hold strong. Even though we've seen a little slowdown in growth, good to see that labor is pretty steady thus far.
Just kind of hang around.
Yep.
Not a bad number, not a great number. Like I said, we're kind of in a mediocre.
We'll take it at this point.
Mediocre type scenario, muddling along.
Hot topic, obviously, for the last 12, 18 months, inflation figures. So really three big indicators there we look at. First one I wanted to jump into, personal consumption expenditure, or PCE index. That measures the change in prices that consumers spend on the goods and services. The index rose just 0.1% from April to May, but it is up 2.6% year over year from last May. This trend is pretty steady though. So if you look at a year over year standpoint from January through May, kind of that 12-month trail, it's been between 2.5 to 2.7. The Fed definitely, they look at this index, a lot as far as inflation goes. So I think that's a good sign for them. But we'll see what happens here over the course of the...
Yeah, the trend continues to be moving in the right direction.
Right.
The reality with inflation and the numbers is it can get lumpy.
Right.
There's some seasonality in the numbers and the way the numbers are calculated that you tend to have better inflation numbers this time of year. June, July tend to be kind of your weakest inflation numbers. So, is this still the trend continuing to that 2% the Fed's looking for,
right,
or is there still work to be done? I think the Fed's pretty much said that we want to see confirmation on this. So I don't see the Fed making any moves based on these numbers. So, jury's still out on inflation.
Right.
I would argue that, inflation well above 2% is with us for a while.
I tend to agree. I mean, two other indices they look at, producer price index. On the production side of things, the index dropped by 0.2% in the month of May from the previous month. If you include food and energy, which tend to be volatile figures, but it was up 2.2% year over year on a PPI standpoint. That's not bad at this point,
gets
right?
That's pushing that 2 number.
That's getting in that, close to that goal of the 2%. The last figure from a CPI standpoint, they really look at all three of these. Pretty flat from April to May. There was a 0.3% bump from from March to April, April to May, pretty flat. Year over year, there was an index increase of 3.3. We talked about this last year where CPI can be a bit misleading just because shelter is such a big component of that. They want to look at all factors, right? It's not just CPI. It can be misleading. Obviously, I think housing will continue to be a big component of inflation, but they want to look at all three. So when you take all three of those from a year-over-year standpoint, we're looking 2.6 on a PCE, 2.2 on a PPI, 3.3 on CPI, but the Fed really values those other two. So I think those, rate hikes they've completed thus far, it is starting to work. But as you mentioned, they're just not ready to pull the trigger on a rate cut at this point. I mean, when you look at, and I listened to Jerome Powell's comments at the last meeting, their average for the Fed members, they're thinking 1 to 2 by the end of the year. I don't even know if I'm buying that. They want more data. They want more validation that we are really curbing and getting steady prices in the economy at this point.
Right, and even when you talk about 1 or 2 cuts, that means going from 5.25 to 5.5 down to maybe 5.
Right.
Maybe get below 5, but not by much. You're still looking at pretty, fairly elevated short-term interest rates.
Sure.
So we have a ways to go there.
Yep, absolutely.
Let's talk about the portfolio, the markets a little bit. June was an interesting month. I'd say if you look at the big tech names, NVIDIA, Microsoft, kind of the Magnificent Seven or the Fab Five, whatever you want to call them, that handful of tech stocks really driven by artificial intelligence, all the hype around what's happening there or what could happen there. Those stocks did very well in June. You scrape those away and look at the rest of the market, kind of a pretty benign month. And we saw some weakness in the market, so it was not a great month. At the index level, the S&P 500 for the month was up 3.67. The Dow Jones only up 1.76. The NASDAQ 4.8, so obviously that's driving tech, and you're seeing kind of a divergence between the Dow, which is broader based, less tech focused, versus the S&P and the NASDAQ, which are very tech focused. Small cap index, the Russell 2000 up 0.56. On the international front, seeing a little bit of pressure there. The EAFE down 0.62%, so slightly negative. Emerging markets they're up 1.32, so not too bad there. The bond market in general, the Bloomberg Ag, up 1.73. That's because we did see longer term rates drop a little bit. I think we came into the month closer to 4.5% on the 10-year, dropped down by the end of the month 4.2. Actually, yesterday, we're back up to 4.4. So, 10-year moving around a little bit. I think that's going to continue on the 10-year. Year to date, so the S&P 14.48%, so pretty good start to the year. The NASDAQ up 18.13, so I kind of put those two together because they're kind of being driven by the same stocks.
Right.
Dow Jones, a little more lackluster, only up 3.79, so I think that tells a little bit more of the story of the real economy, what's really going on, which is a slowdown. We saw it in the GDP numbers, not being reflected in the jobs number, inflation coming down. So I think the trend is correct. We are definitely in a slowdown. I wouldn't call it a crash, but things are definitely slow on the general, in the general economy. Russell 2000 small caps year to date only up 1.02. On the international markets, kind of in line with the Dow, the EAFE up only 3.5%. Emerging markets 6.11, and overall the Bloomberg Ag, the bond market, is actually down 0.71. So, longer term bonds not really doing much. We've stayed short, so fortunately we've been collecting more in the 5% range on an annualized basis. So look at our bond portfolios are probably up 2.5% year to date.
Do you think at some point we'll start to look at going out a little bit longer on the curve? Do you see that where we want to take a little nibble of a longer duration?
Extending maturities?
Yeah.
Right now, obviously my thoughts could change as things progress, but the fact that I don't see the short-term rates coming down in the next couple of months, I don't know if it's really worth going out, extending maturities when we can get our 5.25 in the short term, because I think those higher rates are still going to be there. For the most part, 10-year at 4.4%. I think we'll still be able to get a 10-year between 4 and 5, even when the short end goes down. So I'm not in any rush. It's not worth the risk. And when we're buying bonds as for the fact that we know we're going to get our principal back, we know what rate of return we're going to get. we're not buying bonds for upside opportunity.
Right.
We're going for the known, a known rate of return. When you buy into the stock market, now you're looking for that upside. Yeah, you have some long-term, you have some confidence in what you're going to get long-term in your stocks, but in the short term, it's going to be anywhere, but you also have the upside.
Yep.
Bonds is a different story. That's when we're investing in bonds, we're going for a known rate of return. It's not a speculation play or something, hoping for big returns out of the bond market. It just, it doesn't.
Stability.
It doesn't make sense.
Right.
Why take risk in a, what should be a fairly, low risk investment? And
Right.
if you look at it that way, you're using bonds for low risk. You're losing, to get growth, we want to be in equities.
Yep.
Moving to the portfolios, and, we kind of had a rough month with our portfolios. For the growth with income portfolio, down 0.75%. Year to date, we're still up 9%. So year to date looks good. Just a, kind of a lackluster, bad June. Down 0.75%. Big gainers, NVIDIA, we hold that stock in there. That was up 13%. Iron Mountain, which we've been in for about a year or so, up about 12%. Apple up 10%. So kind of once again around tech, Iron Mountain, they are data storage. So obviously they're getting a lot of love in this environment. Laggards, Nike, they took a big hit last week. I think this should be the final shakeout for Nike from the downside. I only see upside from here. Aptiv, they were down 15% for the month, and then Raytheon down 7%. Nucor also down 6%, so steel's taken down the chin a little bit in this last month or so. For the year, NVIDIA up 150%, Iron Mountain up 30%, Raytheon up 21%. ExxonMobil, which, up 17%, that's giving back a little bit. We've seen some softness in the energy markets, but, we're still comfortable longer term with energy. Nike, year to date down 30, Aptiv down 22, Nucor down 9. Dividend yield portfolio, once again, more defensive portfolio, high quality names in there. Rough month, down 1.6%. Year to date, up 5.5%. Gainers in June, Public Storage up 6%, Coke up 2%, Cisco up 2%. Laggards, Dow was down 8%. That's Dow Chemical.
Right.
Kraft Heinz down 8%, Con Ed down 6%. Year to date, Eaton still leading the pack, up 31%, Prudential up 16%. Merck up 15%, CAT up 14%, Caterpillar. The financials, they've slowed down a little bit, but, Pru's still giving us good numbers there. Laggards year to date, UPS is down 11, McDonald's down 13, US Bank down 6. Appreciation with income, from a individual strategy standpoint, year to date, we're up 13.2. But once again, we took out on the chin in June, down 2.6%, led by, on the upside, Public Storage, up 6, Energy Transfer up 4, Kinder Morgan up 2. So a little bit in the, I'd say, energy infrastructure world. Laggards in June, AES down 18%, Autolive down 16, Mosaic down 6. Year to date, Equitable is still leading the pack, up 20%. JP Morgan up 20%, Bank of America up 20%, Lamar and Merck both up 15%. Year-to-date laggards, Kenvue down 14%. Public Storage, even though made a 6% run, still down 4% for the year. Autoliv down 2%. So that's what's going on in appreciation of income. Price potential, probably, once again, a tough June, down 2.5%. This portfolio historically has always been a great portfolio for us from a growth standpoint. Year-to-date, just nowhere to be found, only up 0.4%. This one we need a little patience with. Like I said, historically, the last 15 years I've been running it, we've always had great returns in here. Just lagging this year. I'm not writing it off yet. I'm not moving away from it.
Right.
Just we need to be patient. It'll pop at some point. Gainers in June, Intuit up 14%, JS Pharmaceutical up 1%. We did buy Alphabet, their Google this month. That's up 5%, so we're getting a little bit of help there. But our laggards, Timken down 8%, General Mills down 8%, AGCO down 9%. Year-to-date, Interactive Brokers kind of leading the pack up 48%. These are ones that are still in the portfolio. Arch Capital up 36%, Cigna up 11%. Laggards, Integra Life Sciences down 33%, Amphastar, which we just got out of, down 35%. So we need to be patient with price potential. It'll do its thing, but so far this year it hasn't. Small cap stocks. So in our SMID portfolio, actually compared to the indexes, we're killing it. Year to date, we're up 10% in there. I think the small cap was only up 1% year to date. So our small caps are doing pretty well. For June, we were down 1%. Gainers, Camtech up 22%, Northeast Bank up 10%, Vertex up 9%, Commvault up 13%, which we only added mid-June. Laggards, Oil Dry Corp down 23%. We did get out of there. Clearwater down 9%, AmRep down 11%, and then IESC down 9%. Year to date, Camtech, a big winner, is still in the portfolio, up 83%. IESC up 76%, even though we gave some of that back. United States Lime and Minerals up 47%, Graham Corp up 48%. Those are still in the portfolio. So, like I said, it was kind of a pretty rough month for our, rough, I mean now 1%. So kind of pretty lackluster month for June. Our portfolios, price potential we got to be patient with. Everything else I think is really performing in line so far.
Do you think, we see a little bit of a lag in price potential compared to these major indices? Do you think, retail investors and a bunch of investors are just rushing to the concentrated, super growthy positions and paying up a little bit too much from a, price to earnings standpoint? Do you think that's causing a little bit of lag there?
Oh, well, absolutely. I think, the stocks that are driving things, the big tech stocks, one is there's been a little bit of a market reaction when things get a little tough because of the cash flows in the big tech firms, which the balance sheets are very good, the cash flows are good, earnings are there, profits are there, but the reality, so when things get rough, everybody rushes back into those stocks. So as we see softening in the economic numbers, okay, we're safe in these stocks, but the problem with it is as you mentioned, valuations are getting very rich on those. The stock prices have gotten bid up beyond their valuations,
right.
I would argue. Now, the reality is that dynamic can last a long time. We don't know when it'll end, what'll turn it, and not just price to earnings ratios, where it's your price compared to your true earnings at the companies that are flowing through the bottom line, but even price to sales, which is that's your top line revenue. Tech's trading at over 10 times price to sales. It's
juicy. Yep.
That's higher than in the .com days. So, that has me concerned. We don't have tons of exposure to those stocks because of valuations. I mean, ultimately, there will be a reckoning where those prices right themselves. We don't know when it's going to happen. It'll come out of the blue, and you could see a major shift in the market at that point in time, but we don't know when. And, we know we can get good returns by sticking with good solid fundamentals, and we don't want to chase those. I mean, that's like starting to load up on Microsoft, Intel, Cisco in 1998. Well, that didn't work out so well because they didn't see those prices again until 2010, 2015. Cisco's never seen the highs it saw back then.
Yep.
And you can get to the same spot with a lot less consternation and not being tempted to sell when things are down, because there could be a big downside there at some point. Like I'll say, I'm not calling for it. I'm not saying, hey, pull everything out of stocks. Know what we're in, know why we're in there.
Right. That's
kind of the key. And we'll 5 years from now we'll be in the same spot with a lot of less stress. Is what I believe is going to happen.
Preservation of capital at the end of the day. We want to make sure that, as you said, we are in those names that we are comfortable with, that we know that if things did get ugly, we trust the company, we like the numbers. It's not, call it sort of a value piece. I don't love that moniker, but better value in those names than some of these numbers that have gotten out of whack. And that's what we want to own.
Yeah, I mean, just because a stock's price, let's say a stock reaches 1,000, if the stock gets cut in half or cut 60% and it's down to 300, that doesn't mean the company's a bad company. It just means you bought it at the wrong time.
Correct.
And that's what we're trying to avoid in chasing some of these stocks, and we will continue to avoid that because of just the shifting sands of what's happening out there. Like I said, the economy is starting to slow down, which needs to happen. Wring out the excesses. I think we'll continue to be on that track. I'm not looking for a recession anytime soon. Some people would argue maybe if you took away big tech, maybe the rest of the economy is in a slight recession right now. Could be, but hey, we've kind of had those, call them stealth recessions in the last 5-10 years.
Sure.
But we are going into a more normalized interest rate environment where we have positive rates. The interest rate, we're still an inverted yield curve.
Right.
And, that can last longer. I mean, it doesn't make sense, but, it can and probably will last longer. And until that rights itself, that's really when you finally have the new cycle start. So we're not really even into a new market cycle or a new economic cycle until we get out of that uninversion.
Right.
So, kind of sum things up. In the next couple months, I think we're going to see more of the same. The election, I don't see a lot of effect on the market. The economic effect of either candidate, they both like to spend a lot of money. So I don't see anything happening from the government's going to keep on spending money as long as they can.
Yep.
I don't see any major changes to the tax code because once again, they like to give money away. They're both going to give money away. So I don't see a whole lot happening there. Now it's really the economy doing its own thing. And, there'll be a lot of fireworks, probably headline risk, which can move things in the short term. But I think the path we're on now is, just kind of a slowing, and then a normalization of the interest rate world.
Yeah, and I think, word to the wise, don't get caught up in a lot of the clickbait around how the election can impact markets, et cetera. What's really important is, whoever comes into that seat, is it going to cause tax legislation changes? Is it going to impact, long-term financial planning strategies? Right. That's what we focus on, not the daily clickbait of media. Right.
And
focus on what's important.
The tax piece is going to be important because, in 2026, a lot of the tax policy that was put into place in 2016, 17, after Trump was elected, a lot of that sunsets. So there are going to be some changes. I don't think it's going to be draconian. If Biden gets in, he whacks everything. No, there'll be give and take. You're going to see probably a little bit of elevation of tax rates, but nothing substantial.
Right.
Nothing that's going to move the needle. The estate tax, could they knock that down from 14 million down to 10 million? Yes. Is they going to knock it down to 300,000 back in the Clinton days? I don't think that's going to happen.
Be a tough sell on the Hill.
Exactly. So, there's going to be some changes, and those will be a little bit longer term, and those are things that we address along the way. Other than that, everybody have hope you had a great 4th of July if this doesn't get released till after then, and enjoy the rest of enjoy your month of July for your summer, and we'll be back here in August with latest updates.
Thank you.